You think you borrow money from a bank. You don't. When you finance a car, you are not borrowing money. You are buying it. Buying money at retail. And like everything else on the lot, it has been marked up. There is a number attached to your car loan that the bank calculated, that the lender approved, and that you were never shown. It sits between you and your own interest rate, and the gap is not an accident. It is someone's paycheck. By the end of this, you'll know exactly what that number is, how much it quietly took, and why the person who sold you the car needed you looking at one thing so you'd never look at the other. The rate on your loan was never just a rate, it was a price, and someone set their margin on it. Start with what you think happens. You sit down at the dealership. You want to finance. In your head, the dealer walks over to a bank, the bank looks at your credit, and the bank hands back a rate. Clean. Neutral. A number the market decided. That is not what happens. The moment you apply, the dealer takes your credit application and sends it out. Not to one lender, but to several at once. Each lender looks at your profile and sends back a number. This number has a name the industry uses internally and almost never says out loud. The buy rate. The buy rate is the real one. It's the actual interest rate the lender is willing to accept to fund your loan, based on your credit, your income, and the car. It is the wholesale price of the money. And here is the first thing they were counting on you not knowing. The dealer is under no obligation to show it to you, ever. So now you have a number you've never seen, sitting in an inbox you'll never open. Which raises the obvious question. If that's the real rate, then what's the rate they actually give you? This is where the wholesale price becomes retail. The lender says, I'll fund this person at 6%. The dealer receives that. Then, before it ever reaches you, the dealer does something the lender explicitly allows. They add to it. They mark it up, and they hand you the higher number, as if it were the only number that ever existed. The difference between the rate the lender approved and the rate you signed for has a name too. It's called dealer reserve, sometimes finance reserve. And it is not a fee. It's not a service charge. It is pure margin. The profit the dealer earns for taking the bank's number and quietly raising it. Think about what that actually is. The dealer did not lend you a cent. The dealer took on none of the risk. The lender carries the loan. The lender eats the loss if you default. The dealer simply stood in the middle, raised the price of someone else's money, and kept the difference. For the life of your loan, you are not paying them for money. You are paying them for the act of marking up money. And most people never find out it happened. Because to notice it, you'd have to see two numbers. The one the bank gave and the one you got. And the entire process is built so you only ever see one. So, the practice is invisible. Fine. But invisible doesn't mean small. So how big is it really? Let's stop talking in theory and put real figures on the table. And these aren't mine. They come from the lender's own regulators. First, how common is this? According to a 2023 analysis out of MIT, roughly 78% of loans arranged through a dealer carry a marked up rate, not a fringe tactic. The default, nearly 4 out of 5. Second, how much do they add? The Consumer Financial Protection Bureau, the federal agency that supervises the lenders themselves, describes the mechanism plainly. The dealer receives the buy rate and may have an incentive to charge you more. The typical markup runs 1 to 2.5 percentage points on top of the rate you actually qualified for. Now watch what that does. Take a clean, ordinary example. A $30,000 loan, 5 years. The lender approves you at 6%. The dealer marks it to 7, one single point. It feels like a rounding error, the kind of number you'd wave off. Over the life of that loan, that 1 point costs you roughly $840. $840. Transferred from you to the dealer, for nothing. Not for the car, not for the loan, for the markup itself. And that's the polite version. 1 point, good credit. The Center for Responsible Lending puts the average hidden rate added by dealers at 2.47%. And if your credit is weaker, the markup climbs, because the less you know your options, the more room there is to raise the price on you. So that's one buyer, one car. Several hundred to a couple $1,000 sitting in someone's pocket that you never agreed to hand over. Now hold that number, because it's about to stop being personal. One car is a story. Every car is a system. The Center for Responsible Lending ran the math across the whole market. The dealer markup, this one practice, this quiet raising of a number you never saw, adds an estimated $25.8 billion in hidden interest over the lives of American car loans. $25.8 billion. Not from selling cars, not from the metal, the doc fees, the add-ons in the back office, from standing between you and the bank and adjusting a decimal. And remember what that decimal is doing. It's not sitting still. It rides every single monthly payment for the entire length of your loan. 60 months, 72, 84. It compounds against you the same way it would have compounded for you if it had stayed in your pocket. Every payment, a little more goes to the markup instead of the car, which leaves one question that should bother you more than any number so far. If this is happening on 4 out of 5 loans, and it's costing people billions, and it's been documented by the government itself, how do they keep you from noticing while it's happening to you? They point you at the wrong number. Here's the whole trick. In one sentence, they get you to negotiate the payment instead of the price of the money. Watch how the conversation goes at the desk. They don't ask what interest rate you want. They ask a softer, friendlier question. The most expensive question in car buying. What monthly payment are you comfortable with? The second you answer, you've handed them the wheel, because a monthly payment is not a fixed thing. It's a dial. And they can turn that dial to hit any number you say, while quietly changing everything behind it. You want the payment lower? They stretch the loan from 60 months to 84. You'd never accept a higher rate to your face? They bury it inside a payment that still feels fine. The markup disappears into the comfort of a number you can afford. That's the sleight of hand. You think you're winning the negotiation because the payment came down. But the payment was never the point. The payment is the curtain. Behind it, the total price of the money. The rate, the term, the reserve stacked on top is where they were making the real margin the entire time. You were looking at, can I afford this each month? You were never shown, what is this money actually costing me? Those are two completely different questions, and the whole finance office is designed to keep you answering the first one out loud so you never ask the second. So strip the curtain away and look at what the car loan really is. The rate on your car loan is not a rate, it's a price tag on money. The bank sets the wholesale cost, the dealer sets the retail markup, and you, walking in believing you were borrowing from a bank, were actually buying money from a middleman at whatever margin he could fit inside a monthly payment you'd nod at. You never saw the buy rate, you paid the sell rate, and the gap between them, the reserve, was the price of your own trust, collected from you one payment at a time by someone who lent you nothing and risked nothing. The number was always small enough to ignore. 1 point, half a point, a rounding error on a page you didn't read. That's exactly why it works. The math never lies.